Welcome to the Common Investment Meeting for the New York City Retirement Systems for December 18th, 2019, the final Common Investment Meeting of 2019.
And of the decade.
Of the decade, okay. However, we have not been doing Common Investment Meetings for the entire decade, but that is an accurate statement. Okay. We are going to call all the meetings to order, and then we will get started with the substance. So let me start with NYSERS. Would you please call the roll, Ms. Winery?
Chair, Mayor's Office.
John Adler, present.
Comptroller's Office.
David Jetter for Controller, Scott Stringer.
Public Advocate's Office. Borough President, Manhattan.
Alger Rafael Bonilla on behalf of Manhattan Borough President Gail A. Brewer.
Borough President, Brooklyn.
Tanya Campbell, representing Brooklyn Borough President Eric Atlas.
Borough President, Bronx.
Martha Camille Sabia, representing Bronx Borough President Ruben Diaz Jr.
Borough President, Queens.
Alan Swisher for Queensborough President Melinda Katz.
Borough President, Staten Island.
Isaac Gordetsky for Borough President James Otto.
International Brotherhood of Teamsters.
Lawrence Bosley for Ruben Torres for President Greg Floyd.
Transport Workers Union.
David Katzman for TWU Local 100 President Tony O'Donnell.
District Council 37.
Raymond Santander for Executive Director Henry Garrido.
We have a quorum.
Thank you, Melanie. Next, teachers. I can't actually see who's going to call the roll for teachers. Ms. Budzik.
Yes. John Adler,
Yes, I'm here.
Thomas Brown,
Here.
Natalie Green-Giles,
Here.
David Kazansky. Present. Lindsay Oates.
Here.
Deborah Penny.
Here.
Susanna Vickers.
Here.
Thank you, Valerie. Next, for police, is it Mr. Sens over there?
Yes, Mr. Facilitator.
Thank
Good
you.
morning. All right, present for the PBA.
Joe Alejandro, and before we go on, I want to wish everyone happy holidays, Merry Christmas, and whatever your tradition, may you have a happy and healthy one.
Thank you, Joe. DEA. DEA?
Kenny Sparks for Mike Palladino. Happy holidays. I did not want to come today, but that's okay.
SBA. LBA. CEA.
Johnny Ramirez, designee for Roy Richter.
Police Commissioner.
Stephanie Zimber for Commissioner Shea.
Mayor's Office.
Shuman Ray for Mayor Bill de Blasio.
Commissioner of Finance.
Phil Dukes for Commissioner Jacques Gihat.
And last but not least, the Controller's Office.
John Dorsett, designee for Comptroller Scott Stringer.
All right, Mr. Facilitator, we have a quorum.
Very artfully done, Bob. Thank you so much.
You're quite welcome, sir.
And for the Fire Pension Fund, Mr. Dunn?
Good morning, John. For Mayor's Office.
Cynthia Collins, designee for Mayor Bill de Blasio.
Controller's Office.
Jennifer Konovitz, designee for Comptroller Scott Stringer.
Finance.
Phil Dukes for Commissioner Jacques Gihat.
For the UFA, Mr. Gerard Fitzgerald.
Eddie Brown for Gerard Fitzgerald.
Robert Eustace.
Robert Eustace is downstairs, but I have his proxy for now. He's calling his way up.
Eddie Brown.
Here.
Mr. John Kelly.
John Young with John Kelly's proxy.
Okay, and John Young.
John Young.
Got okay. UFOA. Mr. Jack Kelty.
Here.
William Guilfoyle.
Here.
And Paul Mannix.
Here.
And for Fire Commissioner Dan Nigro.
Terrell Brown for Commissioner Nigro.
Thank you, Pat. And for the Board of Education Retirement System, Mr.
Morning,
Rich.
Mr. Adler. We're represented today by trustees Natalie Green-Giles, Lindsay Oates, and Russell Buckley. We do not have a quorum, but we will administer this business tonight at our regularly scheduled Board of Trustees meeting in Brooklyn. Everyone's invited.
Okay, thank you, Sandy. All right, the meetings are in order. And with that, we will turn it over to the BAM staff to do public quarterly performance review. Mr. Donier.
Yes, good morning. We will begin with the market overview by Michael Haddad.
Good morning, everyone. So as usual, I'm going to kick this off with an update on public markets in the third quarter, and I'm going to divide my time between markets update on the third quarter, some narrative around that, and then switch to 2020 and some themes that we're likely to talk about, and conclude with a quick look at current asset allocation in all of your portfolios. So let's just jump right in. This is the typical slide that shows returns in public markets in Q3. And one change to this slide I'd like to call to your attention is the far right column of expected returns. These have been updated for the 2019 returns from your 5 consultants. This is just an average of the 5 consultants. So that's gone from the 2016 expectations to 2019. And just as a reminder, public equities, which are the first 3 rows on that, which make up about 50% of your portfolio. Expected returns are all lower in 2019 as compared to 2016. And as a reminder, in U.S. equities, that's about 200 basis points lower. Emerging equities, about 300 basis points lower. So with that being said, takeaways from this slide. Q3 was really all about interest rates, both the Fed and other central banks around the world. And you can see that in the bottom rows. You can see the very outsized positive returns from long-duration government debt, up almost 8% in the quarter and almost 25% on a one-year basis. That's just extraordinary returns. 30-year debt was down almost 45 basis points in the quarter, so a huge move resulting in those returns. Call your attention to investment grade and high yield. We're going to spend a little more time in a few slides. Investment grade spreads were virtually unchanged in the quarter. High yield spreads were wider. And some dispersion of returns within the different components of high yield. So that's something that's concerning to us, and again, we're going to spend a little more time on that. Within the equity market, the U.S. equities were slightly higher in the quarter, developed international slightly lower. Not much really to say there. Emerging markets down on the quarter, down on the year. And this all has to get into the slowing global growth situation as well as the ongoing trade disputes between U.S. and China and a few other countries as well. So let's talk about what happened in Q3. So a continuation of the global slowdown, and as I mentioned, the central bank easing cycle, and then I really want to spend some time on the dispersion within the credit markets. It's a concerning development in markets. So as to the slowdown, again, slowing trade, slowing industrial production, and as a reminder, the trade war was intensified during the third quarter as Trump announced additional tariffs in September. The slide on the right is it's a JP Morgan slide that shows the global services PMI and the global manufacturing PMI. So this is not country specific, it covers the whole globe. And what I would call your attention to is the continued decline of both of those throughout the year, and how low manufacturing actually got sub 50, which is typically identified with a recession. Services PMI also slowing, but not to the same degree. But this is kind of just encaptures the continued slowdown that was happening in Q2.
PMI?
Purchasing Manager Index.
I'm sure everybody else in the room knew what that was.
Sorry, thanks for that. So what changed in this global slowdown was the central bank response. So as a reminder, in the end of 2018, the Fed was still raising rates. They pivoted to be on hold throughout the first half of the year, and then in the third quarter, they pulled the trigger and actually have taken back some of those rate hikes. They cut rates in July. They cut rates in September. Beyond the scope of Q3, they also cut rates once in Q4. In addition to the Fed, the ECB lowered rates at the end of September, and they resumed quantitative easing. It wasn't just about those central banks. Several EM central banks listed on the slide also cut rates. And what the slide on the right shows, the graph on the right shows, is the cumulative number of interest rate cuts on a 6-month rolling basis. And you can see, ex the financial crisis, there's a lot of rate cutting going on around the world. And that has been not only supportive to government bonds, but supportive of the equity market as well, just through the power of lower rates and how we discount things. So what did the markets do? As you would expect in government bonds, we expect a rally. So what the chart on the left shows is the 10-year yield, and that dropped sub 1.5 at the end of August. And as a reminder, the 30-year yield was sub 2% at the end of August. And as a reminder, that's the lowest yield ever in the history of our country. On the right-hand side is the 2-10s curve. Why do I show that? A lot of press about the flattening of the yield curve, and when it inverts, it's a signal to a recession. And sure enough, it inverted at the end of August. It finished the quarter slightly positive, but that flattening environment existed throughout the quarter. And indeed, the yield curve flattened dramatically, and that's what helped long government bonds outperform short government bonds. More interestingly is the dispersion of returns within U.S. credit. And specifically on this slide, I wanted to address high yield. So the graph on the left on this slide shows the 3 credit ratings within high yield, going from least risky to most risky. The double Bs are in the blue, the single Bs are in the yellow, and the triple Cs are in the red. And you can see going into mid part of the year, not much dispersion of returns. They all kind of tracked very closely. And then starting around June and continuing through third quarter, and actually continuing through December, you see, you can just see the different slopes of the lines. And on the right-hand side, you see the actual returns. So what's unusual about this is you get double Bs positive on the quarter and triple Cs negative on the quarter. Why is that important? What does that possibly mean? Triple Cs are the most risky part of the capital structure within high yield, and actually down on the quarter. So by risky, it could be either by the strength of their balance sheet, it could be the industries that they're in, host of factors that the rating agencies use. But I think what we're concerned about with BAM, that this is one potential vulnerability within the equity market, is the amount of debt that corporate America has taken on over the last several years. And this is potentially the canary in the coal mine, that the companies that are most levered, that are most exposed to slowing growth, are actually going to turn and start suffering in their capital market structures. So we see that in here, that triple Cs were down on the quarter. They continued down into Q4 as well. So this is a source of risk within markets that hasn't manifested itself yet into the equity market, but it's certainly happened in the credit market.
Mike, can you sort of explain what the implications or what your concerns are about our high yield portfolio versus sort of equities in general from this? Yeah.
Miles reminded me he's got some risk slides on that as well. But I guess
in terms of, leading up to asset allocation or anything else, what would this suggest to you about high yield right now?
I would answer the question more about equities. High yield is a small part of each portfolio, somewhere between 4 and 8%, something like that, where equities are 50% of our portfolio. U.S. is 30% of our portfolio. So if this is the canary in the coal mine, I'm worried about U.S. equities more so than high yield. One thing that we have done within our high yield portfolio is we have defensive managers, core managers, and aggressive managers, and we have Wesley and team have moved that portfolio to more core and defensive, and for the first time in a while, we have outperformed the index, and that's because of that pivot to more core and more defensive managers. So I feel comfortable that within the portfolio construction within high yield, we have mitigated risk to the degree if these trends continue.
Okay. Thank you.
Before I leave Q3 and talk about 2020, any questions or comments on Q3?
Okay, you're good.
So three themes I think we're going to spend a lot of time talking about in this room and in our different investment roles in 2020 are U.S. politics, the global slowdown, and interest rates. So let's start with U.S. politics. And as much as we've heard about it and as much as we really don't want to talk about it, the president is probably getting impeached today and most likely getting acquitted by the Senate in a month from now. And away from any the political comments, I want to comment from a markets perspective and why this is important. And first of all, I'll say the impeachment itself and whether he gets thrown out of office or not doesn't seem to be a market impact, because if he stays, then the policies remain the same, and if he leaves, it'll be President Pence, and the policies are likely to remain the same. So from a market standpoint, the impeachment is a non-event. I would say what's more important from a market standpoint is how the probabilities are going to sway between on the presidential election between whoever the Democratic candidate is and the president, whoever the president is, and then also importantly, control of the Senate. And I think as we see this impeachment process play itself out, there are a handful of very important seats up for grabs in the Senate, and whether the Senate stays to Republicans or switches over to the Democrats is going to be important from a market perspective. Secondly, we're about to embark on the presidential election. As a reminder, the Iowa caucus is February 3rd. In fact, there's four primaries in February. But they're only 1% of the vote of the Democratic delegates. So while they would be important from a media standpoint, they're really not going to shift to a significant degree who the candidate is. I've listed 3 important dates in the table on here. So Super Tuesday is when almost 37% of the delegates will be awarded. That may or may not lead the markets to a conclusion who the candidate is going to be. But then you can see by the end of April, when we get to vote, almost 80% of the delegates will be assigned by that point. And again, that may or may not lead to a conclusion of who the Democratic candidate's going to be. And why is that important to markets? In my opinion, until the Democrats put up their candidate, we can't really trust the polls and rely upon the polls from a market standpoint. Once we know the candidate, I think the polls become more important, and whether we end up with how those polls are going to sway are going to impact markets. And then also the Democratic convention is in July. There's some chance that the Democrats don't have their candidate picked by then, and it might be what's called a brokered nomination. And again, if that's the case, then we're not going to know until July who the opponent is for the president. And then lastly, the election is in November. Second topic, economic growth. Recession, slowdown, and recovery. So the graph on the left shows 3 different indications of the probability of a recession within 12 months. The first line, which in my opinion is most important, is the blue line in the middle, and that's based on economic indicators. So you can see throughout the year that's been kind of unchanged, somewhere around 40% plus or minus a little bit. So that one hasn't moved a lot. What has moved is the solid yellow line, and that's basically based on the yield curve that I mentioned previously. And as a reminder, the 2s10s yield curve did invert for a short period of time in August. So you can see the probability of that went up as the curve inverted to almost 70% probability, but that's now retreated as the yield curve has re-steepened out. The graph on the right is the same graph I showed you in the beginning about global purchasing manager index, John, not PMIs. And those numbers have ticked higher over the last 2 months. So as we're debating whether this is a recession or a slowdown, there's been some indication around the globe that there's been some recovery from the lows that we've had at the end of August. And then lastly, this weekend, a handful of very important events took place. Is first phase 1 of the trade accord within China and U.S. So not only were additional tariffs averted for Sunday, but the tariffs that he put in place in September were cut in half. In response, China has agreed to purchase an additional $200 billion of U.S. exports over the next couple of years. So that has taken some of the concern about the tariff war off the table. Secondly, England had their vote. They elected in an overwhelming fashion Boris Johnson. So that's reduced the risk of a hard Brexit. So again, a risk reduction that's taken place. And then just a couple other items. Whatever the acronym is for the new trade deal, NAFTA 2, that got passed. That's, again, taken some risk off the table. And lastly, Congress has put forth a $1.4 trillion budget for the next year, and that is expansionary, increasing the deficit again, not unexpected in an election year, but that's pro-growth as well. So there's a lot of green shoots, if you will, about the globe recovering out of its very slowdown. Why does it matter? So what this slide shows is equity drawdowns of 12% or greater over the last 70 years. The slide on the left is when the equity market has had drawdowns when we've not been in a recession. The slide on the right shows equity drawdowns when the economy has been in a recession. And if you take your eyes to the sum at the bottom of that slide, when we've not been in a recession, the drawdowns have been on average about 17%, and they've only lasted for 5 months, and equity markets have recovered in 5 months. But you can see in recession periods, those statistics are very different. Drawdowns are much greater. The length of time that the drawdown has taken place is greater, as well as the recovery. So when we talk about whether the economy is in recession or not, it has a huge impact historically on the equity market, and that's one of our concerns about the U.S. equity market here and the potential for some kind of drawdown. Lastly, interest rates. So this slide shows the cumulative total of negative yielding interest rates in the world. And you can see through 17 and 18, that number hovered around 8 trillion, plus or minus a little bit, and then really started accelerating in the second half of 18 and all the way into August of this year. And that number reached almost $17 trillion of interest rates. As a reminder, mostly Europe and Japan. As the world has slowly recovered and rates have moved higher, that number has dropped to about 11.5 trillion, which is still an enormous number. And just in terms of reference, prior to 2014, that number was at 0. So this is not a normal course of events that we've experienced in the past. It is what we're dealing with now, and it has implications for asset markets if this is going to go away. So why might it go away? In Europe, there is a rigorous debate about whether negative interest rates have helped or hurt the economy. The arguments for it helping the economy is it lowers rates, it's stimulative to the equity market, it makes it easier for borrowers to pay back their debt. Think about Southern Europe. The arguments that it hurts the economy are basically threefold. One, it impacts the banking system because the banks have to pay to pay the central bank to leave their reserves on hold. When banks' profitabilities are damaged, they're not as aggressive in their lending. And as a reminder, in Europe, about 80% of credit creation takes place through the banking system. So in Europe, it matters. The second implication is it hurts the insurance industry and it hurts pension funds. So when you lower interest rates, you gain from what you have, but your reinvestment is going to be tougher, and it damages that. And lastly, at its essence, it's a transfer of wealth from those who save to those who borrow. And those who save, when they start making less money on their savings, they tend to save more rather than spend more. So that's kind of the crux of the argument. There's been a change in central bank leadership in Europe. Christine Lagarde has been on record of saying she is in favor of additional fiscal stimulus, really points the finger towards Northern Europe. And there seems to be a shift underway that some type of meaningful fiscal stimulus is going to come out, and in return, a willingness to raise policy rates from -50 to 0. That's Europe. Japan, they announced another new big fiscal spending program earlier this month. It's a meaningful number. It's caused growth upgrades to Japan. So there's some reason to think that Japan may try and escape negative interest rates as well. And with the Fed, like I said, they've eased 3 times in the second half of the year. They have been very explicit. They don't expect to move rates through 2020. And at the same time, they're undergoing a monetary policy review, which is a meaningful review. It doesn't happen very frequently. The last time was in 2012. And what the big concern is about how to get inflation back to its target, and whether there should be some kind of inflation makeup. So that strategy is underway as well. Any questions or comments on any of these themes? Current asset allocation review. There were virtually no changes from a tilt perspective. So any changes on these slides versus a quarter ago are to change in market values. And as a reminder, the equity market was down about 1%, up 1% in the quarter, so there's not much change here. So let me just go through these quickly because these are unchanged from the previous year. The one place where we are overweight is in our government sector, and we're slightly underweight in mortgages and credit. And as a reminder of your duration extension plan, the bottom 2 rows show where your duration was as of June and where it is as of September. And the percentage amount is the amount that the duration has been extended as a percent total of the total plan that we all agreed upon in 2016. Not much change in teachers, police, and fire, who all have the longer duration. A little bit of a change with NYSERS and BRRRRs, and that was because you do have a slightly shorter duration, and when we take money out of your portfolio for benefit needs or for capital calls, when you reduce your short treasury bucket, it just by math increases your duration. So that wasn't anything so-called purposeful on BAM's part, but just rather the math of moving some money around for other investments in your portfolio.
Questions on the duration of the asset allocation, current asset allocation? Okay. Thanks, Mike. Alex?
Thanks, Mike. And now we'll review actual performance for the third quarter of the calendar year, first quarter of fiscal year 20. So here are simply a snapshot of the system's AUM through September 30th of 2019. You see in the aggregate $208.5 billion of AUM. So here we have overall performance for the systems versus an index portfolio, 65-35 index portfolios, equity and fixed income, and we also show the TUX universe. For the third quarter of the calendar year, the system's performance ranged from 56 basis points for BRRRRs to 1.23% for FIRE. Performance was either generally ahead of an index portfolio for teachers, police, and fire, or it slightly trailed that index for NYSERS. And really, the biggest detractor of performance in the quarter, as you heard from in Mike's presentation, was emerging market equities, and that's both the EM index returns were negative in the quarter, and the managers across the portfolio, your EM managers also underperformed the EM index in the quarter. Now, this underperformance, particularly for most systems excluding BRRRRs, was offset by strong performance in your private markets portfolio, and that will be primarily PE, non-core real estate, and infrastructure. Now, for BRRRRs, you had meaningful underperformance in EM equities, and we'll see that in a couple of slides coming forward. Award coming up, I should say. So that led to that 56 basis points of performance in the quarter versus an index portfolio, as you see, of 1.09%. What I'll also point out, if you look at for the 1 year trailing, all systems are slightly behind the 7% assumed rate of return. But for the 3 and 5 year trailing periods, 3 and 5 year periods, all systems, excluding teachers, are ahead of the assumed rate of return. You see teachers in the 5 year period, which is the column furthest to the right, is just slightly below 7% of 6.96%. And of course, in those longer dated periods, well ahead of the Tux universe. And remind everyone that Tux reports gross of fees. Numbers for the systems, for all systems, are net of fees. So here's a snapshot of the total portfolio by system and its performance. If you look at the far left-hand side for the quarter against each system custom benchmark. Now, all systems underperformed their custom benchmark, as you can see from the bars on the far right-hand side. Let's break down the components that contributed to that lag. And you will notice in kind of the middle and the column to the right that for most systems, excluding BRRRRs, it was a mix of both manager and asset allocation. So manager underperformance and asset allocation that led to overall underperformance versus the index. I would say, if you just focus on asset allocation for a second, that despite strong absolute returns in fixed income, and you heard that from Mike's presentation on the government's portfolio in particular in the quarter, the relative underperformance versus the benchmark was primarily driven by the overweight in treasuries and short-term treasuries, which negatively impacted performance in the quarter as the long end part of the curve outperformed in the third quarter. So that's asset allocation. And certainly manager value add certainly is underperformance of your managers versus their custom index. So turning now to U.S. equities, you see U.S. equities performance for the quarter. Performance range from 21 basis points for NYSERS to negative 17 basis points for BRRRRs. Teachers was essentially flat in the third quarter. For NYSERS and police, research affiliates was the largest contributor to performance, as the portfolio value and large cap tilt contributed to outperformance for NYSERS and police. Fire, Ceradix outperformed the most, and for BRRRRs, Wellington underperformed the most in the quarter in U.S. equities. Here you have the EFI portfolio. Clearly, looking at the far left-hand side, it was a tough quarter in international developed, with performance ranging from a negative 89 basis points for teachers to a negative 282 basis points for BRRRRs. Across all systems, I would say I would highlight Spruce Grove drove underperformance for all systems. And for all systems excluding teachers, I would also comment that Spruce Grove's out of benchmark exposure to emerging markets further added to underperformance in the quarter. Now for NYSERS, police, fire, and BRRRRs, I would also add that Baillie Gifford was a contributor to underperformance in the quarter. For BRRRRs, the large underperformance was actually driven by all four managers. So all four of your managers in the EFI portfolio underperformed for the quarter. That being said, I would note that if you look at the 3-year trailing numbers, all systems are outperforming their custom benchmark in the 3-year trailing period. Turning to emerging markets, again, all systems underperformed the benchmark in the quarter, ranging from a negative 40 basis points for BRRRRs to negative 64 basis points for teachers. For teachers, NYSERS, police, and fire, I would highlight DFA as a primary driver of the underperformance in the quarter. Now for DFA, both elements of their strategy, that would be style and size, underperformed versus the benchmark. So value for DFA underperformed versus growth, and small cap underperformed mid to large cap names in the portfolio. For BRRRR, it's Acadian. As you know, that's the sole active manager in the EM portfolio for BRRRR, and that underperformed. The fixed income portfolio. So again, I'd point out, and just as was pointed out by Mike in the markets overview, investment grade and mortgage investment grade outperformed in the quarter. So the investment grade portion of the portfolio, mortgages slightly underperformed in the quarter. That being said, most of the underperformance that you see here on the far left-hand side here is attributable to the treasuries part of the portfolio. So the government's part of your portfolio underperformed versus the benchmark, to be clear. So again, long duration outperformed in the quarter as the yield curve flattened. And although we did close that duration gap, you'll remember, again, the slide from the first presentation, we are still below, the systems are below their duration target. So that results in the overall portfolio underperforming in the quarter where long bonds outperformed. Turning to high yields, all systems outperformed in the quarter, and you can see the ranges there being from 52 basis points for FIRE to 3 basis points for BRRRR. The high yield market, again, just to reiterate, we saw dispersion of performance with lower rated bonds, the triple Cs, underperforming relative to single Bs and double B part of the market. T. Rowe Price, I would highlight, which is one of the managers with the largest allocations for all systems, excluding BRRRR, continued to generate very strong performance. And that's certainly driven by their portfolio exposure to higher quality credits and strong security selection. Now, BRRRR lagged the other systems. I would just highlight you had a divergence of performance in your two managers. You had Mackay Shields, which outperformed, but Nomura has more exposure to the triple C part of the market. So that led to some underperformance overall. Bank loans just slightly outperformed the index, and I would mention that BRRRR only has one manager there, which is Barings, didn't outperform to the same extent that you saw some of the other managers in the other systems portfolio. ETIs. So ETIs continues to outperform in the quarter. As a reminder, the duration of the ETI portfolio is longer than the benchmark. So we're not surprised when we continue to see results as we see here for the quarter. So outperformance in a low rate environment. Turning to hedge funds for police and fire, the overall portfolio lagged the benchmark in the quarter and also slightly trailed in the calendar year-to-date period. And we would really expect that certainly this year when we had such strength in the underlying market. So when markets rally, we would expect to see these types of results. Nonetheless, if you look at the longer dated period, the 3-year trailing numbers, the hedge fund portfolio has outperformed. This takes a look at hedge funds without the impact of the tactical trade. So again, you see what we call the direct hedge fund portfolio underperforming the benchmark in the quarter and in the calendar year period. However, police and fire's portfolio in the 3-year trailing period has meaningfully exceeded the benchmark. And then just isolating the tactical trade has also underperformed the benchmark in the quarter and the calendar year to date period and since inception. This was put on, I believe, 15 months ago in the spring of 2018. And we're not, again, surprised by this result. You'll recall that the tactical trade was a defensive move to rebalance out of U.S. equities, and we've had strong U.S. equities performance. So turning to the private markets, David.
So before you get to the private markets, if we could just go back to total structured fixed income for a moment? So at our asset allocation 3 years ago, when we had made a decision to move into long duration, we had set a target, and then BAM had recommended that we ease up on that target, right? And so now we're seeing the effects of that. Have we missed the boat in trying to, and now we've set the bar again high for long duration. Have we missed the boat on this, or are we expecting that long duration will still continue to be the right move going forward?
That's certainly the debate we're having now with the new strategic asset allocation. Certainly, currently, we're trying to move the portfolios towards their targets. So you've seen that the last time we had a meaningful move, David, would have been in the first quarter, where we've narrowed the gap between the target and what the actual portfolio is. And certainly, we will continue to move toward in that direction. We're also in the middle of finalizing our asset allocation and having those discussions on what's going to be the right level of exposure and where along the curve we're going to be. So that's certainly going to have an implication as to the decisions that we make, particularly in 2020.
Okay, and we're about 70% of the way to our target currently.
Yeah, about 75-ish, right? 75% for teachers.
So based on how we're progressing, when is the expectation that we're going to get to 100%?
I don't think we'll get to 100, and I'll defer to Mike on this, before the new strategic asset allocation is finalized, because I think that's actually imminent. But any comment on timing to getting to 100% of target?
I think you started with the right question if we missed the boat on it. It's not lost on me, in the history of our country, we've never had 30-year securities below 2%. Let's just plow in and bet on them going to zero. I don't feel comfortable with that. So what we did with your portfolio in the first quarter, so we hit the pause button, we got about half of it done, and rates went up in yield for almost 18 months. So we avoided meaningful losses during that time period. As the economies were shifting and equity markets were stumbling, in the first quarter of this year, we did a meaningful extension in your portfolios out of two-year maturities into 12-year maturities. We had a rigorous debate within our rebalancing committee. Should we just go to 30s? What guided our decision, in hindsight, which was wrong, is we thought that the 10s-30 curve would steepen more, meaning 10s would outperform 30s more than the drop in yield in 30s. We got it wrong, and it happens. Where do we stand with that? We still have conviction in that. So, we talk about it, if not monthly, daily, and some of the points I brought up about potentially change to negative interest rates are impacting that decision. It's more of a global decision than a U.S.-centric decision, but it feels that the winds are changing in negative interest rates, which are going to impact our long duration, and we have confidence that we're still in the right place with your portfolios.
So turning back to private markets, I think it's OFI. So here we have the opportunistic fixed income portfolio. Since inception returns is what we have on this slide through the third quarter. And you see that OFI is slightly behind the benchmark, plus the illiquidity premium of 300 basis points. Now, in the quarter, the OFI portfolio in the aggregate returned about 84 basis points, and that trailed the public market equivalent, which returned about 1%. And the best performing strategy in the quarter in the OFI portfolio was direct lending. Once again, that divergence that we've been addressing this quarter for the third quarter between triple Cs and higher quality credits hurt some OFI managers that were more focused on both corporate stress and distress names. Here's the PE portfolio. All systems, with the exception of NICERS, actually outperformed the PME, the public market equivalent, to date. And again, I'll remind everyone that for PE and the balance of the private market asset classes, returns are through the second quarter of 19, as performance is reported on a lag. But I would highlight for this quarter, the second quarter of 19 for PE, if you compare it to the first quarter, we continue to see sequential quarter-over-quarter improvement. If you look at overall systems returns, improved about 18 basis points quarter-over-quarter since inception, and that ranges, we have ranging from 9.9% for NICERS to about a little over 12% for BRRRRs. And for the quarter, the systems were essentially flat to the public market equivalent, the public market. This slide is familiar. We try to show here the trends in the PE portfolio through the second quarter of 19. Once again, the y-axis on this chart measures the PME spread, or the percent difference, outperformance, or the percent outperformance or underperformance, I should say, versus the public markets. We break this out into the pre-2011 vintages and the post-2011 vintages. Once again, the pre-2011 vintages continue to trail market returns, with the exception of FIRE, which is just marginally positive, and the post-2011 vintages continue to witness very strong performance in the portfolio. If you just take a grouping of your vintages post-2011 through 2016, these are the more mature vintages in the PE portfolio. In the aggregate, they are exceeding the public market equivalent by 440 basis points, so well above the benchmark, which is the public market plus 300 basis points. Turning to core real estate for the second quarter, core real estate slightly underperformed the PME versus the benchmark for all systems, with the exception of BRRRRs, which was slightly positive. One thing to note, actually, in the second quarter that was material is that changes to New York City rent regulations. You'll remember for some, I think it was called the Tenant Protection Act of 2019, was passed during the quarter. That had some material negative effect on the portfolio. Just to give you context, about 4% of the portfolio, as measured by NAV, is exposed to New York City affordable housing, and that rent regulation, among other things, limits landlords' ability to maximize rents. So some of the managers in your portfolio took down valuations. In particular, I would highlight JP Morgan, the Strategic Property Fund, saw an impact, a negative impact there. Hudson and Related is where you are your managers in affordable housing.
May I ask a question about
Yes.
that? Because I haven't heard that before. I find it surprising because the units that are subject to rent regulation were in the portfolio previously subject to rent regulations. The manager should anticipate them always being subject to rent regulations. And I wonder why they chose to change valuations based on what I would think would be normal underwriting for those types of units.
Because the existing rent regulations, before they were amended, I guess, or the impact of this new Tenant Protection Act, allowed for changes to the rents under certain circumstances. When tenants moved, improvements, so there was provisions. There was provisions that allowed for changes in rents. It is viewed that this regulation over time will limit that ability. So that has impact on the models that these managers were running on the long-term kind of value of these assets.
Right.
So that had a negative impact on where they were marked prior to the law being passed.
Yeah, I understand the mechanics of it, but I would take issue, and maybe this can be a side conversation, with those assumptions that go into the models, because if the assumption by our managers is that they think that they can maximize rent for subsidized units, I think that some board members might take issue with that, because the point of rent regulations is to sustain affordable housing for working New Yorkers going forward, not to have the ability to kick people out and decontrol apartments.
I understand the comment, and I would say the managers are looking at their portfolio,
Right.
and they're estimating what's the cash flows is
Right.
being
Perhaps we should
generated
bring
by that
them in
portfolio.
to ask them about those models, because just from a valuation standpoint, it seems a little strange.
Yeah, but just from a governance point, Susanna, we can't tell any.
No, let's not.
Moving on to the non-core real estate portfolio for the second, yes.
Do we have any idea the numbers that they've said, estimates on how much it will affect the 5 funds?
You know, I don't have the specifics on it. Certainly happy to share. The real estate team is here, so Yvonne Nelson has much more detail. She has spent time with Hudson, as I mentioned, J.P. Morgan and Related, which are the managers in your portfolio that have exposure to affordable housing, and they can give you some of the more details as to where they're seeing impact. I think part of the issue as well, and issue is the wrong word, is that at this point the law obviously is new. It was just passed in the second quarter. There haven't been any trades, so there haven't been any sales of properties, since the law passed. So valuing these assets have been difficult, but when they're running just their models, that's looking at cash flows, they do think that they're going to yield less than they were forecasting in the prior quarter. So they took the mark down, and that had an impact on returns, obviously.
Thank you.
I think I skipped non-core. So on the non-core real estate side, you're looking at performance since inception, and all systems have outperformed the benchmark with the exception of Fire, which is slightly underperforming since inception. What I would mention here is that Fire has, continue to mention that on the non-core side, some of the legacy investments, pre-GFC investments, have had a negative impact on returns, and Fire has some meaningful exposure to a couple of names, pre-GFC investments, which are dragging down its performance. So that's what explains that slightly negative performance versus the benchmark through the second quarter of 19 for Fire. And again, when we just look at performance overall for non-core real estate and disaggregate that into the pre-2011 vintages and the post-2011 vintages, we certainly see that pre-2011 all systems, with the exception of teachers, continue unfortunately to underperform the market. But since we implemented changes in strategy and underwriting in 2011, we've seen meaningful outperformance versus the market and versus the benchmark in the post, I should say, 2011 vintages in the non-core real estate portfolio. And last but certainly not least is infrastructure. Infrastructure portfolio continues to perform strongly. To date, I should say, the portfolio is about 44% funded. It's diversified among 135 companies to date, primarily North American exposure. It's 44% of the portfolio, and about 31 or so, 30%, a third of the portfolio in Europe. The largest sector exposure that you have is renewables, and it's about 27% of the portfolio is in renewables. Again, performance has been very strong. And any differences among the systems is due to allocations to underlying funds and opt-outs. And again, as you would expect, looking at the more mature vintages within the infrastructure portfolio, they're all enjoying very strong outperformance, and that's driven by some early realizations that we've discussed in the past in the infrastructure portfolio. And with that, I'll take any additional questions on third quarter performance. Thank you. And now we'll have Miles, who will do the quarterly risk report.
Hello. So I'm up here for two purposes today. We're going to spend a little bit of time talking about the quarterly Blue Box reports that we released. I'm also going to touch on, make a few comments about one of the issues Mike highlighted. And then following that, we're going to do the annual risk update. So let's start with the Blue Box reports.
Miles, I think you have two microphones.
Well, sorry. Well, I can turn this one off. I'll just. Okay. We'll let Susanna comment on how we should direct managers to mark their assets to market.
Oh, good. I'm happy to have that conversation.
Okay.
Thank you for pointing the microphone in my direction.
Okay. Anyway, let's start with the Blue Box reports. Given that you're going to hear from me twice today, we're going to keep this section fairly brief. I typically start off by looking at the macro factor report. I think that's kind of most appropriate, or the highest level reporting that's available in the Blue Box reports. So on this one, I want to draw out a couple of different things here. This system, we can see from the bars in the table on the upper left, is slightly underweight equities. It's about 1% underweight its factor exposure to equities. The other thing that we notice is if we look to the right, that it's also slightly underweight in exposure to credit and slightly overweight its exposure, this is relative to the benchmark, to rates. Now the comment I want to make here is that this, I probably should have pointed this out before. These graphs are slightly deceptive because the units in which these exposures are measured are quite different. The factor exposure to equity is a percentage, so it's 1% underweight to equities. The factor exposures to rates and to credit are expressed as duration. So you can see here that the credit exposure, for instance, is it's basically amounts to about a quarter of a year less credit durations, credit spread duration. What that means is, in lay terms, it's just that the maturity of the credit risky instruments that the system owns are about a quarter of a year shorter than the benchmark itself. That's really not that much of a difference. So the magnitude of the bars relative to one another is, as I say, a little deceptive because of the difference in units that are being shown here. Sorry, it's a little in the weeds, but I wanted to make that point. The other thing to draw out on this page is that this particular system has almost 92% of its risk. You can see this in the table on just below the bar chart. About 92% of this system's risk is coming from just two factors, equity and credit. In this case, it's whatever it is, 87% to equity and the rest to credit, a little over 5. That's the lion's share of the risk. The only diversifying factor exposure is rates, and it's relatively small. You can see it's about negative 1.5% of the contribution of the risk taken by market risk taken by the system. The final thing I want to draw your attention to on this page is the selection risk down on the bottom, which is a relatively high contribution, a relatively high portion of the active risk taken by the system is due to this factor. That's not inappropriate given that we have active managers at work, and this just means that they are taking bets versus the benchmark. With securities within the benchmark, but they are doing their job and they're making active calls. This page, I realize in hindsight I probably should have drawn some boxes to highlight some of the points I want to make here. This is a report that MSCI generates for us, and it explains the change in risk over a quarter. In fact, we've sort of glued two of them together here. We're explaining the change in risk of the absolute risk on the left, and then on the right we're explaining the change in of active risk. And just I want to make a couple points here. First of all, this page, every number on it is expressed in basis points. And then the other point I want to make is just in a multi-asset class portfolio, where does risk come from? And it comes from basically three components to the way we calculate risk. the exposure to each asset class in a multi-asset class portfolio, the volatility of returns of each of the asset classes, and the correlation of those returns with the returns generated by every other asset held by the system. So here you can see that in the top line, you see the contribution that changes in each of those components it has caused. So we have a total increase in risk of this system. This is the top line of about 15.5 basis points. That's explained by a 12 basis point increase in exposure, about a 5.5 basis point increase in correlation contribution, and a reduction in the vol contribution, the volatility contribution of about 2 basis points. So I want to dive into that a little bit, and I want to look at where the 15.5 basis point increase in risk came from. An awfully large portion of it came from an increase in industry risk to industry factors. We see of the 15.5 basis point increase in risk total to the total experienced by the total plan, about 14 and a third almost came from risk to industry factors. That in turn, if you go across the industry factor line, was caused by about a 9.4 basis point increase in exposure and about a 5 basis point increase in correlation. Sorry, I'm going a little quickly, John.
Well, what does it mean, exposure? Like, define that. Unless everybody else knows, and then you don't have to.
Well, exposure could be an increase in just the amount of, the percentage of assets in that asset class held by the system. That would be an increase in exposure. What's on that chart is not the actual change, it's the contribution that the increase in exposure has made to the risk of the system. Is that helpful, John, or?
Forget it. It's too long a discussion for.
Yeah, there's a lot of numbers on this page, and I probably should have circled some of them, drawn arrows, but this is, I don't know if this is a report we distribute as part of the Blue Box package. If there is interest, we can include it in future. It's something we look at to try and understand what's going on with the reports. So looking at some of the other changes in factor exposures, we note that the risk to credit spreads. So spreads is a reference to the credit factor. We noticed that exposure came down. The risk came down by about 3 basis points, and we noticed that that's due to a decrease in exposure to credit risk of about 3.3 basis points. That was adding to that was a reduction in correlation, a slight increase in volatility. The other thing to call out here is the exposure to, it's expressed here as a term structure, I think, but in fact that means rates. So the risk to that factor decreased by about 1.7 basis points, and that was due to a small decrease in exposure and a fairly marked reduction in rate volatility of about 1.5 basis points. So looking at active risk, the only other thing I want to mention is total correlation, which you see was about 5.45, was almost entirely explained by the change in industry correlation of 5.18. What that means is that the diversification benefit of investing in securities issued by different industries declined because the correlation of the returns from those industries were deemed, in the eyes of the market, to have increased. So there's less diversification benefit enjoyed by the portfolio in terms of understanding its risk, given the perceived increase in correlation. All right, I'm going to get off this report soon. It's probably dizzying in terms of the numbers on it. But I did want to also mention the total change in active risk, which was 2.46 basis points. That's explained by a almost 4 basis point increase in exposure, which is offset in terms by an offset. It's offset by a reduction in volatility. So I'm happy to go into more detail about this report, or as I say, we can distribute it if in future it's something you'd be interested in seeing.
Miles,
Sure, absolutely. Sorry,
I just
I
asked.
went through that quick.
No, it's totally fine. I hope what I'm asking is not a stupid question.
Well,
But
it probably were.
But I'm asking you, that's never stopped me before. So obviously this is a explanation of what has already happened. How is any of this information useful to you and to BAM in determining what we should be doing going forward?
I'm not particularly good. This is Mike's bailiwick at predicting returns, or your consultant's bailiwick. I think the thing that we do want to do a lot more of, and it's a priority for us in 2020, is to make better information available to you. And in particular, one of the trustees almost a year ago said to me, Miles, it's all very well knowing this is the risk and then being told what the return is, in some different portion of our presentation. But what I want to see is specifically manager by manager, sub-asset class or asset class, what was the return and what risk was taken in order to generate that return. And that is improving the reporting that we make available both to you and internally to staff in 2020 is probably our top priority. And I'm going to go into a bit more detail on that in just a few minutes. But before I do that, I'm going to finish with the, and any of this stuff, if there's any questions, I would always encourage you, feel free to anybody to reach out. We are happy to provide more detail.
Is it appropriate to also understand this in terms of the additional risks or impact when we're underweight, overweight, and don't rebalance?
I'm going to spend some time on that too. I'm going to get through the blue box issue, and then I'm going to talk about some of what we've been doing in 19 and what the priorities are for 20, and that is one of the priorities. Increasing the transparency as to what the impact of any tilt has been on system returns is definitely a priority. So I will touch on that in a second.
Before you continue, Miles, I would add for David and for all trustees, that this having the ability, that we've been able to implement over the last several years through Miles and his team and be able to identify exposures throughout the portfolio and risks has been very instructional and informative, not only to Mike and I, but also the investment teams to understand where they're making recommendations potentially and and potential impacts of those. I think prior to having the ability to see that, certainly you think of private markets, we were recommending managers solely based primarily on performance and where we thought prospectively they would perform. We didn't have a perspective as to how it impacts our current exposures in the portfolios and where we need to be careful or mindful of potential landmines by adding certain risks to our portfolio. I think that has been very additive and transformational to the teams as to how they think about also recommendations prospectively.
All right, so the only other thing I want to touch on is sort of part of the quarterly update portion of the discussion today is to jump into something both Alex and Mike have alluded to. This is an earlier version of a slide that Mike had in his presentation. I only put it in here to remind you of the remarks he made. And I didn't actually realize he changed it until he went through his deck this morning. On the left-hand side, we're sort of highlighting the performance of different sectors within the high yield index. And we note that the energy sector got hammered. It had a drawdown of almost 5%. And then the other, on the right-hand side, is actually what one of the graphs that Mike did include, which is, it just details the returns of different components of the high yield index, the double Bs, single Bs versus the triple Cs. And as Mike pointed out, the triple Cs did not perform nearly as well as the other components of the index. So the reason I bring this up is I want to spend a little time diving further into those returns, then look at the exposures of the system, and then look at the consequence of those exposures. So to do that, I just want to, this is excerpted from something we make available in reports that we generate. This is just where spreads are by sector. This was actually generated just a couple days ago. We generated almost every day, but on it we do look at returns in the third quarter, and you can see the triple C's, double C's, and D's. Those spreads are pretty wide, have widened. Yields obviously also increased, and we note that returns, particularly in the third quarter, well, yeah, not even more in the current quarter, but the returns got hammered in the C and D category by almost 7%. And similarly, in the triple C category, we see that the returns for the quarter for that section of the high yield index were hit by almost a 2% drawdown. So here, given that sort of description of market activity, I want to take a look at the impact that had on one of the systems. And so here, there's a couple things that I want to sort of this report to surface. The first thing is in the table on the left. We draw out the top spread factor exposures to the top spread factors, and the very top one we see is to energy triple Cs, and we note that. There's a reasonably significant underweight to that, and given the extremely high volatility of that section of the high yield index, it accounts for 34%. That underweight accounted for 34% of the active risk taken by this system, and we'll see in a minute that benefited the system. The other thing well, those are the two interesting observations to make on this page with regard to the high yield exposures. On this page, we take a look. This is the active risk in the high yield portfolio of this system by rating bucket. That's displayed in the bar charts on the right. And what we can see is that they're slightly underweight the exposures towards the bottom of the rating spectrum. And then as you go up into the B, B1, B2, B3, we see that there's a slight overweight. And as you ascend further up the credit spectrum, we see again that there are a couple of underweights. I apologize because what you'll see in the next page is we're mixing S&P's rating buckets with Moody's rating buckets, which is slightly confusing, but I think we can all translate to pretty easily. Well, what you'll see next is not that complicated. So given these exposures, given the market sort of dislocation described when I went over the returns, I wanted to look at what returns this portfolio experienced and why. So here we have a summary of the high yield, this particular high yield portfolio's returns, and we see in the double B category there was an allocation effect which cost some money, but as we move over to the triple C category, we notice that the allocation effect actually was very positive. Remember that the managers of this system collectively were underweight to that bucket. We also see in the selection, which is the gray bar there under triple C, that those managers seem to be doing a pretty good job in choosing securities. Either they didn't own the worst of the triple Cs, or the ones they owned were amongst the better triple Cs. But what that resulted in was a portfolio return of 1.8%. That's not annualized. That's how much it was up in the quarter. We note that the benchmark return was about 1.3%, and that the active return generated was thus about 47 basis points. So given the market turmoil, and given the fact that the exposures were across the credit spectrum and some of the managers seem to have exhibited some skill, that was a pretty, I would term a pretty reasonable result. All right, that's all I was going to say in terms of an update on the quarterly Blue Box reports. So I don't know, do I step right into the annual risk update, or?
Any questions on that before he steps into the risk update? Okay, go for it, Miles.
Okay.
Yes.
So here I want to spend a little bit of time going over what we've been involved in, what we've been looking at in 2019, and then I want to spend a little time talking about priorities for 2020. But before I get even into that, I want to step back and at least give you my view as to what the responsibilities of the risk team are. So first and foremost, we've been charged with implementing a multi-asset class risk system. That's the risk system that the trustees authorized us to procure nearly 3 years ago now. In addition to implementing it, the risk team is tasked with generating reports that will inform you, the trustees, as to what's going on, and will also inform BAM in its, with regard to its responsibility to surveil the portfolio. The next set of responsibilities are related. These are really responsibilities that the risk team has taken upon itself, and they are to develop a couple of proprietary tools that are very helpful to us in surveilling the portfolio. The first of them is something I'm going to call, or we call, the BAM ribbon. It's simply an Excel ribbon. It's a way of making available literally hundreds of pages of information that we generate based on the trustees' holdings data, the same data we send to MSCI. We join that with some information we get from Bloomberg, which is on static securities data, and we get a small amount of not complicated risk data from Bloomberg that we incorporated in these reports. Now, none of this factor stuff, but we do get durations and credit spread durations and things like PE multiples on equity securities. This is something that's available to everyone at BAM via Excel. It installs itself and is becoming more and more widely used within the organization. The next thing that we've done in terms of developing proprietary systems is to build our own mean variance optimization model. Mean variance optimization is a technique you're probably all familiar with. It's the way that multi-asset class portfolios are designed. It basically identifies the highest return portfolio possible given a specified quantum of risk, and I'm going to talk a little bit more about that as we get into it. The next set of responsibilities I want to touch on briefly is our contribution to the investment process. We employ what the risk team. Another thing the risk team is charged with is employing basically analytics to inform manager selection and portfolio surveillance. This is something that we, that's a major, assignment. We also, as a member of the risk team, and I participate on behalf of the risk team in a number of committees at BAM, the Greenlight Committee, the Investment Committee, the Rebalancing Committee. I also, in conjunction with Alex and Mike, have played a role in or been part of the strategic asset allocation discussions. The final sort of set of responsibilities is something of a grab bag of things that the risk teams ended up being responsible for: monitoring basket clause compliance, maintaining the excluded companies list, utilizing data to assist the trustees in determining whether or not they want to add to potential divestments. And then finally, we periodically try and take a look at structural or process inefficiencies within the organization. I'm going to skip through this one pretty quickly because it'll get repetitive if I don't. We finalized the MSCI. These are the accomplishments in 2019. We finalized the MSCI implementation. As I mentioned, we employ analytical tools to inform manager selection. We developed BAM's rebalancing application, modeled the strategic asset allocations, independent. We've given your consultants return expectations. We modeled them ourselves to better inform our ability to contribute to the discussion. We analyzed the impact of ESG-motivated divestments, developed a framework to measure and monitor environmental sustainability investments. Anyway, that's a quick overview of the accomplishments. I want to next turn to priorities for 2020. Here, absolutely the most important initiative of the risk group is going to be to finish the design and implementation and release of these new risk dashboards, which I'm going to describe in a few minutes in more detail. These dashboards are going to supplement rather than replace the blue box reports. We also want to take a look at, over the course of the next year, we want to take a look at a few of the benchmarks we employ to evaluate performance of several asset classes. In particular, I want to take a look at non-U.S. equities, PE, and infrastructure. And then the final thing that we will do, of course, is to continue to provide analytic support to the manager selection process. All right, I'm going to touch briefly on analysis and reporting. By far and away, the most important thing here is to finalize the dashboards. We are getting close to having completed the design of dashboards for the CIO, deputy CIO, the risk team, anybody else that wants to take a look at the total, high-level total exposure of a system. We intend to further develop reporting available through the BAM ribbon. We'll continue to generate the monthly Blue Box reports. The Blue Box reports are generated at our behest by MSCI to some extent. We have made certain stipulations in terms of what's reported on those reports, but they're generated by MSCI, which doesn't mean they're not completely free of errors. So an important thing that we do is try and go through them to identify any errors and correct them before they're distributed to you or to anybody else. And then finally, this priority is, as I say, I've alluded to, it's one of the top priority probably for us. We're going to develop, we want to develop similar dashboards for the system trustees. And I will, again, we want these dashboards to detail risk and return, and I will spend a little bit more time on that in a minute or two. All right, manager selection and due diligence. Again, the risk of repeating myself, we employ analytical tools that we've either implemented or developed to assist with manager selection and due diligence. I think we've done a pretty good job helping the public market teams in 19. We played a role or assisted the asset classes in generating managers further to the bank loan search, the emerging market equity search, the IG credit search. We want to do, we would hope, we're going to strive to develop or give the same level of support to the private market asset classes in 20. In particular, I'm also interested, when turning to private markets, in taking a look at PE performance measurements that adjust for the GP's use of leverage, both at the portfolio level and at the level of the companies that the GP invests in. I also think it might be interesting to try and understand whether or not we should, in evaluating performance, incorporate a sort of a cost, if you will, of the liquidity commitment that we extend, which is our uncalled capital. And then finally, I think in discussions with the PE team, we should take a look at whether or not it would make sense to procure PE-specific benchmarks, by strategy and maturity. Those are available. Again, MSCI implementation. Here, just dividing the tasks up, as I mentioned earlier, we've kind of put all the plumbing in place to load data into MSCI, and we've created the structures to organize that data. MSCI terms that organizational categorization, if you will, as a tree. After obtaining, so in 19 we augmented what we'd done previously because we put in place the plumbing to push all of the alternative data into MSCI. That's Burgess data, which describes the underlying holdings of PE managers, real estate data that's obtained from MSCI. It's called IPD data. We also have incorporated data obtained from OFI's SMA administrators. So that's all in place. We've restructured the trees so that MSCI can accommodate that data. We've implemented something called MSCI Hedge Platform. That allows us to generate risk reporting on hedge funds. And in 2020, we're going to be implementing reporting that utilizes these 4 tiers of macro factors. So the first Blue Box report I went over today reported risk to 6 factors, but performance attribution is not available to those factors. These 4 macro factors start from a tier of 9 and get increasingly granular, and performance reporting is going to be available that relies on those factors. Okay, strategic asset allocation. As I mentioned earlier, we modeled each consultant's strategic asset allocation in BAM's own mean variance optimization model. Probably more interesting, or another interesting thing that we've done with the model is we've evaluated the difference in expected return that each system and the systems in aggregate expect given the constraint, which is the basket clause. Okay, so we've taken your consultant's returns, looked at what an unconstrained portfolio is, look at what the expected return on a portfolio constrained by the basket clause is and quantified the difference. We've also looked at what a partial relaxation, what impact a partial relaxation of the basket clause would have, both on the individual systems and in aggregate. Okay, I want to spend a little bit of, also going to touch a little bit on the rebalancing process. We have developed this BAM application called the Ribbon so that it produces a number of reports that are useful to the rebalancing committee. These are just grids that highlight where we are in terms of NAV in each asset class as a percentage of system NAV. It identifies the NAV, which would be correspond to the target given the last strategic asset allocation, and it kind of highlights the band around that target where outside of which BAM is required to rebalance. The other thing that we've incorporated in the reporting, which supports the rebalancing committee, is essentially a short-term forward look at cash, both sources and uses. What cash is going to be required to pay benefits, what cash is coming in either from the city or additional contributions from beneficiaries. We need to have that information in addition to where we are to determine whether or not we want to add or subtract to an asset class.
But Miles, I'm just going to ask you to try to speed it up a little bit because we're running a little long. Thank you.
Okay. Or we can, so, referencing to a question that came up earlier, we also intend to start distributing reports that track the P&L impact of tilts that are taken by the rebalancing committee. This is something that I've been spending a fair bit of time talking about with Mike. We think it's imperative to create transparency as to what the return impact of tilts taken by the rebalancing committee are. The other thing that we want to do is generate factor reports that can be considered by the rebalancing committee when they look at rebalancing. I'm sorry? Yeah, I mean, sorry. Okay. We'll skip over divestment. It's something we look at. We update the excluded companies list. I do want to spend some time, though. I understand time is of the essence. Going over the dashboards. Is that of interest to you, John, or should we skip that too?
No, I want to hear it. I'm just asking you.
Okay, sure.
We had 10 minutes. You guys allocated 10 minutes to this piece, and obviously that wasn't enough, but we're running long, so.
Okay.
Thank you.
So I think that these dashboards are probably the most important thing that the risk group's contribution the risk group's going to make in 2020. They significant more flexibility than Blue Box reports. Blue Box reports were developed by CalPERS nearly a decade ago. The format is basically, you can't change it. So the nice thing about the Blue Box reports is we have the flexibility to display the information that's of interest to us or to you. We can design the graphics that highlight that information or display it. Yeah, that's the other thing. The main things about, sorry to sort of skip through some of the stuff. The main things that we want to accomplish in these Blue Box reports is to, for each asset class, sub-asset class, or system, put up what the risk was taken in order to generate the return and what the return produced by that asset class was. So that'll be something I expect would certainly be a lot of interest to me. We want to actually go further than that in the sense that we want to compare the projected return given the exposure and the factor returns of each asset class, sub-asset class, system, et cetera, to the realized return. Right, so that we term a residual, and we want to understand where that came from. That's where your manager's alpha is. It's also a term which is important to monitor because if it is too large, it highlights a failure of the whole risk under an analysis process, i.e. modeling failure or data entry failure. So we want to be able to watch that. The other thing about these dashboards, which I think is important, is that they can be made available and generated on a fairly timely basis as of yesterday's close of business. So one of the things we want to do here is involve the trustees in the design of a set of dashboards specifically, for them. And in 2020, we want to basically set up a conversation with trustees. The first part of which will I'll probably ask MSCI to help with, and that's to come in and talk about factors, explain how they're used, why they're important, and then we want to, in a second session, start talking about the design of the dashboards in order to solicit feedback from the trustees. I think the best way to make that happen is show you a template and get a response. And I know time is of the essence, but I want to just spend 2 seconds on just factor risk. These dashboards are going to incorporate and refer to these 4 sets of macro tier factors, in addition to displaying absolute return, relative to return, all the conventional risk statistics. They are going to detail exposure to factors. This is important because factors, these macro factors, are quite intuitive. They detail risk to things I think we all understand: credit, equity markets, commodities. They're really top of the house kind of view of the risks of an asset class or an entire system. The important thing about factors is they cut across all of the asset classes. An asset class is best thought of as like just a label. A factor gets into what are the risks of the things that are housed in that asset class. So an asset class should be thought of as kind of a bundle of factor exposures. And we need to move more towards understanding risk than understanding investment in an asset class. So in the rebalancing process, in our discussions with you, in the strategic asset allocation, those sorts of decisions and discussions need to be informed by the exposures that those decisions will result in. And anyway, that's my bit for today.
Any questions for Miles before we release him from duty? Okay, thanks, Miles.
Yeah.
Oh, sorry, Dave.
Let me say, right.
Mr. Katzman.
Right. While at times some of this is rather incomprehensible to us, the fact of the matter is the trustees recognize the importance of the work of a risk team. And it's clear that a lot is going on, a lot has been accomplished, and there's a lot on the table. We look forward in particular to the conversation about a dashboard for the trustees, and I personally look forward to the incorporation of macro factors.
Great, thank you. And next time I'll perhaps lobby for more than 10 minutes. Thank you.
Thanks, Dave. Okay, Mike?
Thank you.
So I'm going to do a quick strategic asset allocation update. Meetings have started with teachers. There's meetings today with police and fire. You're going to get your first look at the joint recommendation from your consultant as well as BAM. And NYSERS, I think you're scheduled for early next year. While there are joint recommendations from both your investment advisors, we don't ask nor anticipate a vote on it at this point. A couple reasons why. One, it is one of the most important decisions you all will make for your returns going forward. So we want the trustees to have time to absorb it, ask questions, push back, however long that process takes. This again, important decision, so we get it. Secondly, we've talked about the mean variance optimization and what drives it, and that's the capital markets assumptions. We're about to turn the calendar, and your consultants are going to have new capital markets assumptions that we think it's prudent to take a look at that before decisions are made. So what I want to spend a couple minutes on today is we talked about the challenges that we face going forward, and one of them is the basket clause. We refer to it in a non-legal term as the basket clause. The legal definition is on the slide behind you. I'm not going to go through it, but what it details is what we're allowed to invest in, and that's 75% of a listed securities, and then there's these other securities that can fall into the other basket. So we call that the basket. This is more how BAM interprets and operates with this basket clause. So as a reminder, what goes into that basket? International equities in excess of 10% go into the basket, virtually 100% from private equity, private credit, and hedge funds. The combination of real assets over 10% goes into that basket, and high yield in excess of 10% goes into that basket. All right, why does this matter, and why am I up here carrying on about this? thanks to the risk team on putting this analysis together. This is what Miles was talking about. This is the three different efficient frontiers on this graph. The red efficient frontier is a totally unconstrained portfolio, so no basket clause implications whatsoever. The yellow line is a slight tweak to the legal definition. It's just a for example. So, for example, if the amount of international equities was in excess of 30% instead of 10%, what would that efficient frontier looks like? Not quite as good as the red line, but certainly better than the green line, which is where we sit. These efficient frontiers are composed of all 5 systems combined, with each consultants' capital markets assumptions incorporated into that. So this is real. This is what we're dealing with. So the follow-up to that, and this is the same data that comes from that, and these are the changes in expected return. So I would draw your, in reverse order, the portfolio under current constraints is expected to generate over the next 10 years a 6.5% return. And if you note that what we did was we held volatility steady and tried to maximize return. The relaxed basket is 7.1%, the unconstrained 8.2%. And to put some simple numbers around that, if the relaxed basket was we were allowed to optimize to that, that would be an expected increase of about 60 basis points. And our asset size of $208 billion, it's $1.2 billion per year. Where even in government work, that's a meaningful increase. So that's just a reminder of what the basket clause, what the constraint it does to our portfolio, and why we harp on it.
Could I ask a question? Down here,
Liam.
Jack. How come the volatility never changes as you change the expected return? I mean, with unconstrained portfolio, wouldn't you take a little more risk? How does that work out? Doesn't make sense to me.
So what you do is when the mean variance optimization, you do one of two things. You either hold risk steady and try and generate the highest rate of return, or you try and you hold return steady and try and produce the lowest volatility. So what we're trying to do is maximize return. And if you increase risk, you can increase return, but that's not a fair apples to apples comparison of what this example is about. So this is just to show you what the basket clause inhibits us from doing, all of us, not us, BAM, all of us in this room, and to hold risk steady to make it an apples to apples comparison.
Mr. Bonilla.
The language relax basket gives me a sense that somehow we can do something about that, but isn't the law? How can we relax it? Is that within our purview?
I would just remind everybody, it's not within our purview. It's up to the state legislature, but at some point in the coming months, as the representatives return to Albany, maybe it's worth a discussion, and we should talk about that at our individual boards, a strategy for bringing this information to our representatives in Albany. But it's especially timely as we discuss asset allocation, because our asset allocation risk-adjusted optimization is constrained because of the basket.
So, Mr. Facilitator?
Mr. Alejandro.
With a bit of history here, this has been attempted several times in the past to no avail. I believe, when we're going to discuss this, we need to be a little bit more realistic about what the temperature will be upstate to do this. I don't believe this has even been in a discussion with the state controller and anybody else upstate. And given some of the priorities that some of the other people at this table have, and I'm not talking about the political appointees, I'm talking about the unions and other, I'm not sure this is even going to rise into our top 10. So just what are we looking to do here at the end? I don't know, but we have to be a little bit more realistic about it.
Right.
I think it's been
I
attempted
think-
at least 3 times to discuss this upstate and to
Right.
no avail.
Right, and I think, the purpose of today's discussion is just to remind everybody as we look at asset allocation that this is a constraint that is put upon us by the RSSL, and if individual boards choose to address it and think about what we can do about it, I think that's worth a discussion at this time.
be another letter added to the round file upstate somewhere. That's my motion.
And I hear you. And to BAM staff trying to make y'all as much money as we can, this is on the top of our list. And I think the point of this is to try and put some numbers around it. Conceptually, we all kind of get it, and then we wanted to share some numbers, and it matters. So it's something that we have a lot of passion about, and I think as the year unfolds, how we address upstate. I think it's certainly out of my area of any knowledge, and welcome to ideas on how to try and get legislation more favorable inclined for our beneficiaries.
Mike, I hear you 100%, and we've talked about this in the past at this board, and even together. It's just no one sees that denominator effect until the market's hitting near rock bottom, and no one's there yet. No one's even. This is not on anybody's radar screen. Not to say we don't concern ourselves with it, but upstate doesn't care. I hate to say this, they're worried about putting other constraints on other things, and this is not on their radar.
The truth is, Joe, that these sorts of numbers would also apply to other pension funds in the state. And my guess is that if all the pension funds in the state said to the folks that are trying to balance the budget in Albany, and there's a big hole in the budget this fiscal year in Albany, that here's a way that you can actually save money in pension contributions by increasing returns, that might actually find a welcome audience, but none of us know. Anyway, I think it's useful information for us to have, and the boards can take it under consideration. Okay, anything else for this topic? Okay, I believe that concludes our agenda for the public meeting this morning, so we're going to entertain motions to exit public session and go into executive session. Going in reverse order, can I get a motion at fire to exit public session and go into executive session?
So moved.
Thank you, Mr. Kelty. Is there a second? Thank you, Liam. Any discussion? All in favor of the motion at fire to exit public session and go into executive session, please say aye. Aye. All opposed, please say nay. Any abstentions? Motion carries. At police, is there a motion?
Motion to leave public session and go into executive session for police pension fund.
Thank you, Joe. Is there a second?
Second.
Thank you, Stephanie. Any discussion? All in favor of the motion at police, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Motion carries. At teachers, is there a motion to exit public session? Thank you, and enter executive session. I got to keep my mouth straight here. Thank you, Mr. Rand. Is there a second? Second. Thank you, Mr. Kazansky. Any discussion? All in favor of the motion at teachers, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Motion carries. At NICERS, is there a motion to exit public session and enter executive session?
So moved.
Thank you, Mr. Katzman. Is there a second?
Second.
Thank you, Ms. Camille Sabio. Any discussion? All in favor of the motion at NICERS, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Motion carries.
Mr. Facilitator?
Yes, sir.
One moment of business.
In public or in executive? Joe?
In public, before
Okay.
you leave.
Okay.
Unfortunately, we made the motion. There are trustees that walked in and have not been recognized.
Okay.
So maybe you want to do that
before
now.
we turn off the cameras, is any trustees who have entered since roll call, will you please identify yourselves for the record?
Anthony Castiopo, PBA.
Okay. Anyone else?
Bobby Eustace, UFA.
Thank you. Anybody else? Great. Okay. Thank you. So we're now out of public session, entering executive session. Please turn the cameras off.
In executive session, we received a portfolio attribution. We discussed a policy matter and new reporting. We received a review of certain fund-to-fund programs. We received a presentation on a real estate fund. We received a presentation on another real estate fund where consensus was reached. We received a presentation on a public equity manager where consensus was reached. We approved the annual implementation plan for real estate that was presented at the November 20th SIM, and an outstanding recommendation from the October 25th SIM was tabled.
Thank you, Susan.
All right, so do we have a motion to exit? I'm sorry, adjourn, I'm sorry, to adjourn our meeting. So moved.
Second.
All right.
Do we need the cameras?
Cameras on.
During the executive session, trustees heard presentations from their manager and the Bureau of Asset Management in the following asset classes: real estate, public equity, and hedge funds. Decisions were made, details to be made public at the appropriate time.
Okay, so now, given that, I make a motion to adjourn. So moved. Second. All in favor? Aye. There you go. Everybody, have a happy holiday, happy New Year.
Any discussion, any objections? None noted.
Okay, roll call for fire officers. Variable supplement fund for Mayor de Blasio.
Cynthia Collins.
For Controller Scott Stringer.
John Dorso.
And for Commissioner of Finance Jacques Sheehan. And for the UFOA, Mr. Jack Kelty. Yes. And Mr. William Guilfoyle.
Yes.
We have a quorum.
Okay, the board is requested to note the receipt of the quarterly reports.
So noted.
Okay, thank you. Having no other business before the board, I have a motion to adjourn.
Make a motion to adjourn and enter the public session of the fire pension.
So we're out of, okay. Second, we needed a second first. Okay. The meeting of the Fire Officers Burial Supplement Fund is adjourned.
Jennifer Konovitz for Controller Scott Stringer.
Okay, for Commissioner of Finance Jacques Sheehan.
Steve Yap from Finance Commissioner Q.
Okay, for the UFA, Mr. Robert Eustace. And Mr. Edward Brown. Yes. We have a quorum.
Okay, the board is requested to note the receipt of the quarterly reports. Can I have a so noted?
So noted. No, Eddie or Bobby.
Eddie or Bobby, yes. Thank you. Can I have a motion to adjourn?
Motion to adjourn.
A second?
Second.
Any discussion? Any objections? Seeing none, motion carries. Okay, I now need a motion to enter the fire officers variable supplement. Session, the board discussed various investment matters, review personnel decisions, make decisions about candidates to hire, and also discussed action taken on a litigation matter. Now we need to motion to adjourn the regular meeting of the Fire Pension Fund.
Motion.
Second. Any discussion? Any objections? Seeing none, motion carries. Now I need a motion, a roll call for the FSBSF.